What's up, everybody? Nate here, and every single year, economists and the Central Bank of the United States gather together in Jackson Hole, Wyoming to talk about our entire economy, inflation, you name it. And this year, Federal Reserve Chairman Jerome Powell addressed inflation, and he gave a pretty general direction on how the Federal Reserve is going to handle it in the future. He essentially said that the Federal Reserve and himself, well, they are going to use their tools forcefully in order to bring down inflation. And even though inflation was slightly lower in July 2022, this is not the time for them to stop raising their interest rates. They're going to continue to be aggressive, and they're not going to stop until inflation has reached their target mark of around 2%. Not only that, but Chairman Powell said that the economic conditions that the Federal Reserve is creating, those are going to be causing the United States economy some pain for the near to distant future. Now, why exactly does this matter? Well, if you looked at the news directly after Powell's speech, you would have seen that the stock market essentially tanked. The Federal Reserve is trying to raise their interest rates and make monetary policy that is going to bring inflation down. So with the stock market essentially crashing, does that mean that the stock market and the businesses on there and investors don't want to see inflation come down? Well, no, they absolutely do, but this some pain part is really going to hurt a lot of businesses and consumers alike. So I want to talk about what the Federal Reserve is going to do. I want to dive into some of the aspects that Jerome Powell talked about, and I want to go over how all of this is going to affect our economy and, more importantly, inflation in the future. All right, so the first thing I want to talk about here is the Federal Reserve and their tools. Now, the Federal Reserve and Jerome Powell said that they're going to use their tools forcefully in order to bring down inflation, and the tools that they have to do with their interest rate policies and, of course, money printing. The Federal Reserve can spark demand in our economy. That's what they can do with their tools, or they can eliminate demand. Over the last couple of years, we've seen them spark demand by lowering their benchmark interest rates and, of course, printing a lot of money, sending a lot of money all throughout the economy. That made a lot of people go out and spend because now it's really easy to take on debt. Businesses ultimately grew, and they grew really, really fast because investors were taking tons of money and throwing it into these companies so they could grow even faster. Not only that, but we saw the mortgage market and the auto market explode because interest rates were near 0%. People were getting interest rates for 2 to 3%, which is a historic low. That means you're saving hundreds of dollars every single month. Not only that, but the Federal Reserve also printed a whole bunch of money with stimulus and unemployment benefits and all of this quantitative easing for Wall Street. So all of this money was circulating around. The Fed added to its balance sheet, and now in 2022, they are doing the opposite. They are lowering demand by raising their benchmark interest rates. So far this year, they have raised their interest rates a few times. 2 times they've raised them by 0.75%. That is the most that we have seen since 1990. Right now, interest rates for the Federal Reserve sit at a neutral level, right? So they are at 2.25% to 2.5%. This means that they're not too restrictive, so people can still go out and borrow money really easily, but of course, that's not really hurting our economy either. So we're right in the sweet spot. But Jerome Powell has shown that they're going to get more aggressive in the future during their next FOMC meeting in September. That means that we're probably going to see even more rate hikes. Wall Street right now believes that we're going to see a 0.5% rate hike in September, but it could be a lot more than that. What will ultimately happen depends on the data. Jerome Powell said that they're looking at data from not just the last 2 months or the last 3 months, they're looking at a year plus or more of data in order to kind of figure out how they're going to raise their interest rates, but they don't want to loosen them anytime soon. Now, a lot of people have talked about how the Federal Reserve may end up loosening or actually lowering their benchmark interest rates sometime next year, but the Fed right now is not pointing towards that. They want to keep raising their interest rates and making things really restrictive in our economy until, well, we see inflation come down to around 2%. And that is going to cause some pain. So where is the pain going to come from? Well, the first and foremost thing that you're going to see is from businesses. This is exactly why the New York Stock Exchange essentially tanked right after Powell's speech. Because the Federal Reserve is raising their interest rates, this means that, well, it's a lot harder for people to get money. That is the only thing that you really need to know about it. It's harder for consumers to go out and get a mortgage because they don't qualify for a mortgage anymore. That is part of the reason why we've seen the housing market slowly start to shrink over the last about 6 months or so, because it's really difficult for people to go out and get a mortgage because they can't afford the payments anymore because those interest rates are now near about 6%. The same could be said for the auto market, and credit card payments are also getting a lot more expensive because credit cards have an adjustable rate interest rate. So those payments are going up. It's getting a lot more expensive to take on debt. That affects businesses a lot because now new investors, or even just experienced investors, they're not going to start taking out more debt in order to grow a business. They're not going to invest as much as they were before. They only have their own money, so they've got to be very careful on who gets it. In 2021, it was definitely not like that because there was so much money circulating throughout our economy, and the Federal Reserve was stimulating the New York Stock Exchange with hundreds of billions of dollars during their quantitative easing program. Well, that meant that investors could basically spend their money however they wanted to. Businesses were growing their payroll, they were paying people ever they wanted to, and they were basically doing anything and everything they could to grow. But the cost to the Federal Reserve now raising their interest rates is that they're not going to get that investor liquidity, and people just flat out are not going to start as many businesses. It's way too expensive to start a business. It's way too risky for investors and small business owners. So that's just not going to happen. And the first and foremost thing that's going to happen is job loss. Job loss can be a very serious thing for an economy when you have high inflation, because as people have to spend more on everyday goods and services, they also, well, are going to be out of a job if the Federal Reserve keeps raising their interest rates. You see, as people can't buy the same amount of goods and services anymore, that means businesses have less sales, so they're not getting that money so that they can operate, but also they're not getting that investor money either. So they flat out just don't have as much money, and because a lot of them extended their payroll way too much in 2021, they're probably going to have to fire a lot of people or lay them off in 2022 or in 2023, and they don't want that considering they have to keep up with demand in this economy. And as fewer people have jobs, demand is naturally going to go down. That is the painful part that the Federal Reserve kind of needs to happen in order to get our economy back on track. Naturally, people are not going to be able to spend as much money, which means inflation will start to come down as people lose their jobs. So that's the decision the Federal Reserve needs to make right now. They have to be very careful with how they go about that though, because if they raise their interest rates too aggressively and way too high, well then that could restrict too much of our economy and definitely send us into a recession, because now businesses have to fire even more people in order to cut costs. Remember, these businesses at the end of the day want to try to make a profit. They want to try to keep their business alive, and well, they're going to cut people in order to do that. The stock market was hoping that Jerome Powell would say that inflation is now starting to be contained, because look at the numbers. I'm kind of glad he didn't say this though, because July numbers for inflation were definitely not what is actually happening. The consumer price index, which is where the Fed gets a lot of their numbers from, well, this showed that energy prices decreased in July, and that is one of the biggest parts of the index in general. So with that going down, gas prices going down, all of these different things lowering, well, that means that prices did come down, and it means that inflation did go down generally. But in our entire economy, things are still going up, like shelter costs are still rising, and so are food costs. So inflation is definitely not tamed as of yet, and I'm glad that the Federal Reserve didn't take that as a win and say, well, inflation is now contained and we're going to start lowering our interest rates as soon as we can. This means that they are headstrong on bringing down inflation. This is also going to come at the expense, though, of our economy. So they are not concerned with growing our economy right now, which means our economy is probably going to shrink in the short term so that we can see inflation come down. Federal Reserve's goal is price stability, right? So they have to raise their interest rates or lower them in order to make sure that prices are stable all throughout the economy. When you have really high inflation, that means that the prices of all goods and services are starting to rise because there's so much money, there's so much access to money that people go out and spend this money. They've got to sort of reel that in by lowering demand, and people losing their jobs, and of course prices going way up lowers demand. And not only that, but making loans basically impossible to get, well, that lowers demand too. Jerome Powell said this himself. He said price stability is the most important thing. Yes, job loss is bad, GDP shrinking is bad, but what's worse is prices spiraling out of control. control. So the Federal Reserve is going to do whatever they can to now bring down prices. But the interesting thing is the Federal Reserve is doing all of these things, raising their interest rates, but at this point, inflation really hasn't come down yet. Some say that inflation has peaked. We don't really have a lot of data to support that theory, but if it has peaked, well, now they have to start lowering it, which means they're going to have to go above that neutral rate. So we're going to see a more aggressive Fed in the future and higher interest rates into 2023, meaning that all of your markets and your stock market, well, they are all going to come down because there's going to be a lot less investor money. It's going to be harder to take on debt, and consumers are not going out and buying as many homes or just as many things with their credit card or getting an auto loan. So there's just going to be a lot less money, and the stock market doesn't like that. Now, the other thing that Powell mentioned in his speech today is what the Federal Reserve did 40 years ago when we had this really high record inflation, because inflation has been a problem in the US before. In the 1970s, inflation went up to around 14 to 15%. So it was extremely high, much, much higher than it has been so far over the last couple of years. So what exactly did the Federal Reserve do back then in order to bring it down? Well, they had to get extremely restrictive. They continued to raise their interest rates more and more and more until our entire economy basically shut down. We had a recession, and eventually they started to lower their interest rates all throughout the 1980s. But if you remember, during that time, interest rates for just about everything were extremely high. In 1981, the average 30-year fixed mortgage interest rate was around 16%, and it didn't really drop that much further by the end of the 80s. It was still around 10%. But the worry is that the Fed is going to have to get just as aggressive as they did back then, sending us into a deep and prolonged recession where nobody can afford anything. The Fed right now, and Jerome Powell is saying that they still have time to not allow this to happen, to slow this process down. So we might see a recession, but it's not going to be as deep or as long as it was back in the 1980s because inflation isn't that bad yet. I will add one little caveat to this, that the Federal Reserve, well, even though they have good intentions and they want to bring down inflation, it simply might be too late. For one, we have a lot of other problems that are not caused by the Federal Reserve, like supply chain issues and the war between Russia and Ukraine and just energy problems in general. Those things are pushing prices up even higher, and the Federal Reserve can't really do much about them because they only control our monetary policy. They don't control suppliers overseas, and they don't control what happens in Ukraine. That just means that supply is getting lower and demand is getting higher because we still need all of the same things that we needed before, but now it's just a lot more expensive to get them. Not only that, but the Federal Reserve printed a ton of money over the last few years. This is the root cause of inflation. Money printing. At the beginning of 2020, we had around $3 trillion in circulation, and today we have over $20 trillion. The Federal Reserve has printed so much money to bail out Wall Street and, of course, bail out the American people with stimulus check, extended unemployment benefits, all of this money pumped into the economy, and now it's out there. You can only suck so much of it out. The Federal Reserve is trying as much as they can, but at the end of the day, that money's already printed. So there's really not much they can do, and a lot of experts and investors have said that the Fed is way behind the curve when it comes to inflation. They should have started raising their interest rates at the middle or maybe even at the end of last year, but they didn't start till around March of 2022, so they are months behind here, meaning that we could see a prolonged recession that's months longer than anticipated. The last thing Jerome Powell talked about is managing consumers' expectations, and this is one of the most important things for us to consider going forward. Consumer and investor expectations are important when it comes to inflation because, well, businesses and investors are going to spend their money based on what they think inflation is going to be like in the future. Businesses, well, if they think inflation is going to continue to rise, then they're not going to have as many job postings. They might start to preemptively get rid of people because, well, they're trying to make a profit, and that's bad for our economy in general. The same thing can happen with consumers. If consumers feel like inflation inflation is terrible and it's only going to get worse, they're not going to go out and spend their money. They're going to keep their money and save it. That's bad for our economy too. So the Federal Reserve with their monetary policy kind of directs what expectations are going to be. If they're making their really big aggressive moves on inflation, then that means that they anticipate inflation is going to be around for a long time and they have to do what they can to lower it. That means aggressiveness, and that means that consumers should probably be somewhat worried about inflation. And he said that the only reason that a lot of people are focused on inflation right now is because it's directly affecting them. Prices are going up. It's a lot more expensive just to live in 2022. He says that once they can start to bring down inflation, then consumers are not going to be thinking about it as much before, because the fact of the matter is inflation is always in our economy. It's just not this high. It's usually around 1 to 3%. That's the Federal Reserve's target level. If people aren't thinking about it as much, well, then they're going to go out and spend, and they're not going to worry about our economy essentially collapsing on top of them. But will inflation and monetary policy in the United States be like it was in the late 70s and 1980s? Well, it's always a possibility. We definitely can't rule it out. And like the Federal Reserve said, we're just going to have to continue to look at the data and what our economy is doing in the future to be able to decide. But seriously though, this is definitely 180s comeback I do not want to see in the 2020s. But now I want to hear from you on this issue. What do you think about the speech from Jerome Powell? Do you think that the Federal Reserve is doing everything that it can in order to bring down inflation? And do you think that ultimately this is going to cause a really long, bad recession in the United States? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.